Hello, everyone, and welcome back to our new episode of Phillip Trading Podcast. My name is Liao, and today we have Yongxuan with us. She's a dealer in Phillip Capital. How are you doing, Yongxuan?
Hi, Liao. Yes, I'm doing well today.
Okay, good to hear that. Yeah, so today we'll talk about China. So China was ground zero for the COVID-19 pandemic 3 years ago. The complex web of restrictions have choked off growth. Their end has been a long time in coming and eagerly anticipated by the China markets. As soon as the authorities changed at the beginning of November this year, there was anticipation that limitations will be loosened, which increased the value of China stocks. Okay, so let's see what Yongxuan have for us today about the China market. Okay, so our topic for today is light at the end of the COVID tunnel for China. Is it so? Okay, so I will ask Yongxuan a few questions. Okay, so the first question is, with multiple factors happening in China, such as the zero COVID strategy, property crisis, Foxconn protests, etc., can you briefly summarize for us what has been happening in China?
Okay, thank you, Liao. So China, they recently, not recently, a few months back, they also has imposed like a fresh series of COVID lockdowns. And due to also because the numbers of cases is increasing in the country, and including like in a city where workers at the world's largest iPhone factory clashed with the police this week, and also a record daily high in the coronavirus cases tests its commitment to follow the rest of the world in easing the pandemic restriction. So the government are actually responded by tightening the COVID restrictions in cities including those big cities like Beijing, Shanghai, Guangzhou, and also the in ordering for the mass testing. So other than this, the government also have a strict enforcement of China's dynamic zero COVID policy, with almost 3 years has weighed on its economy and also the stock frustration among the population. So on the early of the month, the government actually announced that they would shorten the quarantines and also ease other restrictions, which is also a move seen to be aimed at elevating the economic pressures and also cooling public discontent. So these are the 2 points where currently are still ongoing in China.
Okay, wow. So it seems like a lot has happened. Okay. Yeah. So next question. How have been the China and Hong Kong stock markets performed lately after presidency was elected for the third term?
So the markets are actually in a turmoil as their president Xi Jinping is their third term begins. So like one day into the president Xi Jinping's president-breaking news term as the leader of the ruling Communist Party, the China's financial markets are already in a turmoil, where the investors they are largely ignored rosier than expected GDP data to wipe up almost 10% of the value of the internet giants like Alibaba, JD.com amid a broader sell-off. So it has also been suggested that the private sector was blindsided by the president's Politburo overhaul, where they also take a look on the upbeat at first glance on the GDP, where they expanded about to 3.9% in the third quarter, which increased from the previous quarter about 0.4%. It was also a big thanks to the higher factory output on the resilient exports and also the stronger investment growth as the government spending quicker. Other than this, like in the Hong Kong stocks, they also had their worst day since the 2008 global financial crisis. Just the day after the Chinese leader Xi Jinping, he secured his iron grip on power at a major political gathering.
Okay, thank you. Yeah. Then with Tesla entering China for its electrical vehicle business, do you think China will continue to be a good place for businesses?
I think it's still a yes. Where the Tesla they also have been like selling or shipping for export on every vehicle they could produce in Shanghai, but the inventory levels rose by their largest margin ever in October. In addition, with the factors including like a cheaper yuan against the US dollar, lower raw materials prices in China, and also the rise in Tesla and the new car prices in the United States, they have combined to make the exports from China to the United States potentially cost competitive, where the price gap between the Tesla cars sold in the China and also the United States has been widening, reflecting both higher US prices and new discounts in China, which also means that Tesla vehicles could potentially be exported to the North America at a competitive price. So analysts also have warned of a coming price war of the Tesla, where they slashed the starter price of two of the models, which is Model 3 and Model Y in China by as much as 9% last month. Okay, so with Tesla, they are planning to sell the Model Y for the equivalent of around 49,344 in China, and compared to the US price of around $65,990, where China made cars face a 27.5% US tariff, while light duty trucks face a 25% tariff. With China, the world's largest auto market, imposes a 15% tariff on the imported vehicles. So in 2018, before Tesla Shanghai plant was operating, Elon Musk, the CEO of the Tesla, had also asked the President Donald Trump to raise tariffs on cars imported to the United States from China in order to achieve a fair outcome where both sides had equivalent and also equally moderate tariffs.
Okay, right. Okay, so in that case, how can trader trade or mitigate their exposure risk in the China market?
Okay, like what paths could the investors take able to access in their China exposure take? So one of the option is that they are able to divest from all of their Chinese assets, like reducing their exposure to zero. But by reducing the exposure to zero to China is likely to be a protracted process where it involves like shrinking a portfolio of the publicly traded Chinese stocks or unwinding a private equity investment. And also repositioning will also likely to be complicated as the sellers must find buyers in all already challenged valuation market. However, moreover, investors are also looking to unwind their Chinese holdings must consider the effects on their taxes, their intellectual property rights, and also the transfer pricing, as well as many other stranded costs. And with corporate investors who have long been bullish on the China, would also need to come to terms with the possibility that they might not have any exposure to China's economy when the growth begins to pick up. And alternatively, the investors could also accept the sunk cost, write down the value of their investments, and still also to retain some exposure to China. In essence, this would also mean that acknowledging that previous investments cannot be recovered while holding off on making new ones.
Okay, right. Yeah, thanks Yongshen for the insightful explanations on the China market. So for those who wish to trade or mitigate your exposure risk in the China market, you can now trade China A50 futures with us, Phillip Capital now, with the rate of USD $5 per side per lot now. And if you're interested, you can drop us a message or comment down below and we will get back to you as soon as possible. Okay, so now we have come to an end to our podcast today. And once again, thank you, Yongshen, for the wonderful sharing today. Happy trading, everyone. See you guys next round. Bye-bye.
Bye bye. Thank you.